Hello. The company being analyzed today is Dalmia Bharat Sugar and Industries. As the name suggests, this company mainly it crushes sugar cane in order to produce sugar. So it's a sugar company, but it also has two other or three other business segments. We will talk about that. So today our goal is to analyze this company's cash flows, its revenues, its financials basically, its various business segments. So this is basically a company overview, company slide breakdown. So let's start. So first we have the market cap, 3055 crores. Small cap company basically, pretty small cap, not the largest. Current price of one share is 378 rupees, written directly above me. But the book value per share. Now, what is book value? Book value is the assets of a company minus the liabilities of a company. So the net assets of a company. So book value per share is 400 rupees. So the company is currently trading at a price below book value. Also, this is not financial advice because I can't give financial advice. So return on capital employed is a very small 9.48%, but this is pretty much in the middle when talking about the sugar industry. Return on equity is 12.4%, not the highest, but for a sugar company, it's all right. Dividend yield, it's showing here 1.59% of current price. So that's like 4 rupees per share. I think so. Not 4 rupees, 4 point something rupees per share. So that was the overview of its market cap and I guess market cap and all. Let's go to financials. Here we have the profit and loss of this company from 2014 to 2025. Here we have the revenues, okay, shown under sales. We have operating profit. We have the operating profit margin below operating profit. We have profit before tax. We can see some amazing tax percentages. This is the effective tax rate it's paying. And finally, we have net profits. And all these numbers are in crores. So one thing that you will see that is consistent throughout this analysis is that the company fluctuates a lot. All right, a lot of fluctuation, but we'll cover this. So sales in 2014 were 1,190 crores. We moved to 2018, massive sales growth, 2,244 crores. Okay, 2020, 2,110 crores. 2022, 3,007 crores. 2024, 2,899 crores. And finally, in the fiscal year 2025, we had revenues of 3,746 crores. We had an operating profit on my right, 470 crores. We had an operating profit margin of 13%. Okay. And profit before tax of 350 crores. And this year, the company didn't pay any corporate tax. In fact, it received some money from the government because of some reason. Minus 11%, it got an increase. That's where it inflated its earnings to 387 crores. If not, if it had paid 25%, what is 25% of 350? That's like 70 crores. So 350 minus 70 crores, that's around 280 crores. This figure should have probably been 280 crores, somewhere around that. Yeah, not the best look. So these were the financials. Let's take a look at them in terms of percentages so we can get a better idea. So over the last 10 years, the compounded sales growth has been 13%. Okay. The compounded sales growth for the last 12 years, for the last 5 years has been 12%. Last 3 years has been 8%. And for the last 12 months, TTM is trailing 12 months, sales growth has been 23%. So pretty solid sales growth. Like generally speaking, pretty solid sales growth. Now, compounded profits. The problem is with this figure, right? I'm not sure if they include the tax refund or not. Do they exclude it? Does this figure include the tax refund? But let's just read it. Okay, but let's just read it. Compounded profit growth for the last 10 years has been 60%. Last 5 years has been 14%. Last 3 years has been 10%. and last 12 months has been 44%. Okay. Return on equity has been pretty stable. Last 10 years, 12%. 5 years ago, 11%. Last 3 years, 10%. And last year, 12%. So in that 10 to 12% range. Now, I mentioned fluctuation, a lot of fluctuation. This is the fluctuation. So if we move all the way to 2014, right? We have 108 crores of operating profit, right? This is 2014. We have profit before tax of 3 crores. Okay. Profit before tax of 3 crores. In 2015, we have profit before tax of 0 crores. That explains that 60% profit growth, right? Over the last 10 years, compounded growth rate of profit, 60%, because the base was so low. Okay. Then take a look or pay attention to the operating profit margin and the years. Okay. We have the OPM and then we have the years. So in 2015, we have OPM of 10%, takes a massive jump to 19%. I'm not sure, but I believe this was because of massive increase in sugar prices. Okay. But then dips down. Okay, sorry. 2017 moves again 22%. Then dips to 10% in 2018. Okay, 2019, 12%. 2020, 16%. 2021, 18%. 2022, 16%. So there was a massive rise, 22%, then a fall to 10, and we are again moving back to 18%, 16%. In 2023, it's 13%. Margins of 14%, 13%. We have seen not the most fluctuating margins, but we have seen rises and falls, and right now pretty stable for the last 3 years, 13, 14%. It shows again, sugar is a very cyclical industry. All right. Sometimes there's overproduction, sometimes there's a lot of oversupply. Prices of sugar rise and fall suddenly. That has a major impact on the profits. So profits and profit margins are a bit fluctuating, if that's the wrong word, but okay. In 2021, this figure 472 crores is the operating profit. Look at from 2021 all the way to 2025, operating profit has remained the exact same. This operating profit from 2021, fiscal year 2021 to fiscal year 2025 has remained the exact same. All right. And if you take a look at net profits, take a look at profit before tax. These numbers are profit before tax, exact same. They remain the exact same. And this year, it received a tax refund, which led to this massive increase in profits after tax. The only reason for the massive increase for profits after tax was the tax refund. So these were the revenues from 2014 to 2025. The one good thing about Dalmia Bharat, the cash flows. Yes, the cash flows. Now again, even under cash flows from operating activities, these are extremely fluctuating. All right. Like 2014, we have 267 crores worth of cash flows from operating activities. A great number. Great number. 2015, 2016 minus, okay, 2018, 659 crores randomly. Then the next few years are better. Look at this. Very consistent, like 2018, 583 crores of cash flows. And from 2020 to 2023, we have very positive cash flows. Then fluctuation, minus 123 crores, and now 450 crores. Now, from what I've seen, relative to its market cap, I think Dalmia Bharat has showcased maybe the best cash flow from operations. Relative to its size, at least in the past few years, it has shown the best cash flows from operations. Any company in the sugar industry, I think these are probably the best. At least in the past few years, you can see, right? It's mostly positive. It has shown some great figures. And again, it's a market cap of like 3,000 crores. 450 crores is a pretty good thing. Yeah. So fluctuating cash flows and again, fluctuating profits. We saw operating profit margins are very fluctuating and they have risen, they have fallen, but they're currently in a place of stable like 13, 14%. In cash flows have shown rise and falls, but still, but still, um, yeah, last few years have been a bit positive. And we're going to look now, we're going to take a look at different business segments, what the company actually does. And one more thing I need to mention, the cash flows are so fluctuating mainly because of inventory. Okay, some years is a big buildup of inventory, okay, big buildup of sugar. In some years, there's a big sell-off of inventory. So inventory goes down in one year and significantly goes up in another year. Okay. They buy a lot of sugar, they keep a lot of sugar in stock, anticipating a demand rise or demand increase. So they buy a lot of sugar in advance that builds up inventory that negatively impacts cash flows. And then if demand surge that they predict actually happens, then they sell off that inventory come down, and this massive decrease in inventory significantly boosts cash flows. So now let's take a look at its various business segments. Very slow transition. Now, we see three things there, okay? Three manufacturing capacities. First, we have sugar crushing capacity. What is this? Basically, we get sugar from sugarcane. Dalmia, Bharat, and other sugar mills, sugar companies, they buy sugarcane from farmers and then they crush the cane so they can get the sugar. The current capacity is 43,200 tons of canes per day. Big capacity, and I think they're one of the major players in Maharashtra. Yes, one of the major players in Maharashtra when talking about the sugar industry. Then distillery capacity. Distillery capacity, what are they producing? It's written here 950 kiloliters per day. That's capacity. Cogeneration capacity 138 megawatts. Two different things. So distillery refers to production of ethanol. Yes, and cogeneration capacity is all obviously generation of electricity. Now, what this is basically is that when crushing the sugar cane and producing sugar, they get a byproduct, right? They get a byproduct, I think molasses, and that is used to make ethanol, right? So they use molasses. Dalmia Bharat Sugar uses molasses to make ethanol. And recently, you may have heard of ethanol blending with petrol. Like 20% of I think the fuel we use in our cars do now have ethanol in them. So this is a major push by the government. This is a government major scheme push to achieve 20% that we've already achieved 20% ethanol blending. And so this has been a relatively new, like in the last decade, but now a consistent rising source of revenue for this company. That the molasses, that the byproduct that they form during producing sugar, what can they use it with? They can use it to produce ethanol, which is bought by like oil companies, which can be bought by oil marketing companies. And this is a new, relatively new, stable source of revenue, pretty high margin. Cogeneration is okay, producing electricity. Again, while producing sugar, there's some residue form. I think the residue name is Vegas, and this helps in producing electricity. So they produce electricity, they can sell some of this electricity to the grid, the electrical grid, or they can use it themselves and save some power cost. So this can help in reduce power cost. And again, these two things are just new sources of incomes. So there were 138 megawatts of electricity generation. Okay, 950 kiloliters per day of distillery capacity, that is ethanol production, right? Then this is a 5-year performance of the company, and we have many types of, what do we say, figures, criterias. I think we can take a look at return on capital employed. In 2025 was 11% and has been consistently decreasing from 18% in 2021, 2024, 13%. The reason they have given is that they have seen a decline, see, slight moderation or decline in return capital employed because they're expanding capacity. All right, they're expanding capacity, so that increases the denominator of this return on capital employed figure, right? Capital employed, the denominator has assets, so they're undergoing rapid capacity expansion, which obviously increases their assets. Right. Uh, what should I have shown? Hmm. All right. Here we have two more things. Net debt to equity, net debt to equity, pretty stable, has actually gone down from 0.46 to 0.18. So now net debt, which is long-term debt minus cash and cash equivalents, is now only 0.18 times equity. So lower this figure, the better. Then we have sugar sales volumes. Again, let me show the years also. Pretty consistent. In 2021 was 6.2 lakh metric tons, and in 2025 it's 6 lakh metric tons. So sugar sales in volume terms have not really grown. All right, they have shown fluctuation. Now, distillery sales volumes, ethanol sales, 8.6 crore liters in 2021, all the way to 18 crore liters in fiscal year 2025, highest ever sales. Okay, pretty stable, new source of relatively new source of revenue. Right, all right, all right, all right. Now, this is page 6 of the annual report. You can read all this. This is available on the internet. If you go to page 37, 37, here's a mention of the strategic expansion timeline. And don't worry, we will cover the balance sheet of this company a bit late, a bit later, but we will cover the balance sheet of the company. Now, um, in fiscal year 2025, they acquired Bhagoli Sugar and Distillery Unit. Okay, in fiscal year 2025, they completed capacity expansion projects at multiple units, and in fiscal year 2026, they're expecting commissioning of new distillery projects. So probably increase the distillery capacity that they have. And in 2026, they are planning the increase in there's a planned increase in Bogoli sugar capacity. So it seems that for fiscal year 2026, which is, I think, right now we are in fiscal year 2026, investors can expect increase in expansion in sugar and distillery. So uh, that's pretty good. Yeah. Then this is a bit confusing. I could not understand this. Now here they have given return on capital employed progression from fiscal year 2025 onwards. So here they've said that in fiscal year 2025, they have established the initial return on capital employed level, which I think is 11%. We saw that just a bit early, 11%. They're going to boost return on capital employed with digital advancements. Okay. They're going to increase return on capital employed by expanding capabilities, enhancing ROCE through improved operations, and said they're going to achieve the projected ROCE level. So I don't actually know what the projected ROCE level is. I couldn't find it. Do tell me if you know in the comments. But yeah, whatever the projected ROCE level is, these are the ways they're thinking they're going to achieve it. And yeah, oh, I almost forgot it. Almost forgot it. So here they have mentioned the three business models. Sorry, the three economic segments. Sorry, the three segments, business segments: sugar, ethanol, and cogeneration power. And 71% of the revenues comes from sugar sales, and 28% of the revenues as of now comes from sales of ethanol, 28%. And the remaining 1% must come from then power. All right, power, power, power. Now let's move to page. Oh my God, this was page 37. Page 83. Okay, page 83. Hmm. This is for their cogeneration business. All right, the power generation business. Um, yeah. So the installed capacity is 138 megawatts separated across 6 locations. Units exported to the grid. Okay, in 2025, they exported 20.7 crores kilowatt hour at export realization. The export tariff realization, from what I understand, is basically the price at which electricity is sold at. It's 4.96 rupees. So that comes out, if you multiply these, how much is that? 4.96 into 20.7. All right, that comes out to 102 crores. 102 crores they made revenues from the power generation. All right. So yeah, pretty good. A slight decline in the actual units exported, but increase in realization that led to okay around 100 crores of business from this. Out of the total, what was the total revenue again? I forgot. That's not good. All right, all right. Okay, here we have it. Yeah, 3,820 crores. My bad. Then, here they have mentioned current ratio. Current ratio is current assets divided by current liabilities. It's 2.59. Uh, Current ratio below 1 can be concerning, but it depends on the industry in which a company is operating in. Last year, it was 1.55 for Dalmia Bharat Sugar. This year was 2.59, so nice increase. Debt to equity ratio, okay, 0.13. Last year, 0.18, so an increase. Lower the number, the better. Debt service coverage ratio, all right. Debt service coverage ratio. I think this is basically, yeah, debt service. Yeah. So EBITDA upon debt service, the interest you have to pay plus some of the principal amount that you have to pay that you borrowed, right? So it shows how many times the EBITDA of a company is above its debt service, that is interest plus repayments. All right, this is shows the financial health of a company in one way, and it was 4.6 times, a nice increase from 3.2 times. Yeah, anything above 1 is seen nice, anything below 1 is that can be concerning, but 4, really nice, really nice. 4.6, even last year was 3.21, so it seems that's pretty good. Here we have a lot of other ratios which maybe we can cover. Return on equity, 0.13, that's basically 13%. Okay, 13% return on equity. All right. Inventory turnover, ooh, 2.18. I think higher the number, the better. So, okay. Then we have two more ratios. Let's not take a look. These are important, but let's not take a look. Now, we had this page. We had this also. Let's take a look at all the way to page 142 with the balance sheet. Everyone's favorite part, the balance sheet. I was covering the balance. In the balance sheet, what can we see? We have, okay, let's see. All these numbers are in crores. Property, plant, and equipment, 1,785 crores. Okay. Financial assets. These are non-current assets. Basically, these cannot be converted into cash within a year. If these assets were to be converted into cash, it would take way more than a year, basically. Okay, non-current assets. In financial assets, we have investments worth around 582 crores. Trade receivables are at very small. Uh, in current assets, now these are the assets which can be converted into cash within 1 year. These assets, current assets, in many ways represents the liquidity of a company. When compared to current liabilities, it's very important to look at current assets and current liabilities, and also the composition of current assets. Now, here under this, we can see the company has, hold up, what are these numbers in again? Yeah, these are in crores. Yeah, these are in crores. All these are in crores. The cash and cash equivalent, the company has 333.34 crores of cash and cash equivalents as of fiscal year 2025. Around 10% of their market cap they have in cash and cash equivalents. So very a lot of cash. But the company has, oh my god, is this actually in crores? Okay, it's in crores. They have 1,656 crores of inventory. This includes raw materials that they have. This includes the goods that are currently being made, and it includes the finished goods, the goods now completely manufactured and ready for sale. The company currently holds. All right, raw materials plus goods still being manufactured plus the finished goods or the goods now completely manufactured and ready for sale. So they have 1,656.77 crores of inventory, which I think is it's pretty common for a sugar company. Yeah, yeah. So current assets, 2,228.18 crores. Okay, all right. Let's take a look at liabilities. What do we have? We have borrowings. We have borrowings. These are non-current, I think so. Yeah, these are non-current liabilities. So borrowings more than 1 year. Okay, more than 1 year. 513 crores worth of borrowings. Deferred tax liabilities, a tax that they have to pay. 210 crores. Okay, 210 crores of tax, deferred tax liabilities. All right. Last year was 247 crores. Okay. Current liabilities that they have to pay within this year. Okay, we have borrowings of 530 crores. Okay. We have trade payables, which is basically um, when the supplier of a company has supplied them like raw materials and all, but they have supplied them on credit. So the company can pay them back for the goods they supplied after a few days. After some period of days, there are trade payables, 190 crores of trade payables, bringing the total current liabilities to 861 crores compared to total current assets of 2,228 crores. And if we see it, if we take a look at last year's current liabilities, we see a massive decrease in borrowings from 1,092 crores to 533 crores. Again, I'm confused. Are these numbers in crores? Okay, Jesus, 1,000 crores to 500 crores. Massive decrease in trade payables also from 381 crores to 198 crores. Now, again, I think if you're taking a look into this company, analyzing the balance sheet, I think I can say, I cannot recommend, but I can maybe suggest that you look through a few years to see like this is a massive fluctuation from 1,600 crores worth of current liabilities to 861 crores. It's like almost a 50% decrease. So take a look for a few years if this is a common trend, these massive fluctuations, right? Even in current assets, was there? Okay, current assets was 2,400 crores last year, 2,200 crores. That was the balance sheet. 300 crores of cash, 1,600 crores of inventory, 2,200 crores of 2,200 crores of current assets. Out of that, 1,600 crores was inventory. Massive amount was inventory. Then only 300 crores was cash versus 500 crores of short-term borrowings. Okay, okay, all right. They did have a very solid over the debt service coverage ratio, so that's a plus for their balance sheet health. Then we move on. Oh my God. We move on. Yeah, the notes of inventory. Now we saw 1,600 crores of inventory. We need to take a look at this inventory. What is this? So of the 1,656 crores, we have finished goods of 1,500 crores. We have raw materials of 80 crores only. All right. It seems pretty common for the company to have like 1,500 massive amounts of finished goods inventory. Now they have mentioned note number 35. Let's go to note number 35 to get a higher clarification about what this is. Yeah, note number 35. So under this, we can see the inventory. The opening stock and closing stock. Opening stock is well inventory at the start of the year, closing stock inventory at the end of the year. Let's take a look at the end of the year. At the end of the year, we have inventory worth 1,286 crores worth of sugar inventory, finished products, finished goods only. Okay, this is finished goods only. Okay, remember? So of this 1,500 crores finished goods inventory, we have 1,200 crores worth of sugar, 65 crores worth of industrial alcohol, and okay, all right. So 1,200 crores worth of sugar. I guess they have to do this. They have to do this. They have to pile up a lot of inventory and then sell because the sugar producing season will of course not always coincide with the sugarcane producing season, if that makes sense. Sugarcane is produced, they have to take all of that in bulk, like all the sugarcane in bulk, and then they sell it. So it's something like that. It's pretty common, massive inventories. I believe at least the sugar industry is pretty common, or I don't understand. balance sheets. Could be both. I think the second. Okay, 162. All right. Segment assets and liabilities. Hold up. Segment assets and liabilities. 2,795.7. Okay, 2,700 crores worth of company's assets are for the sugar segment. Distillery segment has around 892 crores, and others is 524 crores. Okay, segment liability. Latest figures. 1,000 crores worth of liabilities, money owed to others, is for the sugar segment. 371 crores is for distillery segment. Okay. Then revenue by geography. This year, they generated 3,690 crores worth of revenue from operations domestically, while only 55 crores were generated from overseas. And there's no single client of this company who has contributed 10% or more of the company's revenue for both fiscal year 2025, fiscal 2026. So for client concentration risk, if a lot of the revenue comes from one client, it seems to be not a lot, not even 10%. No client contributes to even 10%. So under that, that's pretty good. Then we can see this. Yeah, this is revenue from operations by the segment. So for fiscal 2025, we have 2,419 crores of revenue coming from sale of sugar and allied products, 107 crores worth of revenue coming from sale of power, and 1,198.96 crores worth of revenue comes from distillery. So 28% of revenue comes from distillery. Okay, all right. So I think these are most of the things we need to see. Yeah, one last thing I wanted to show was a very slow transition. Yes, yes. This is WordPress. Sorry, this is Word, Microsoft Word. Uh, one more information about the company. The company is heavily dependent on government policies. Okay, the major raw material of this company is sugarcane, and the government decides the price at which sugarcane is bought from farmers. All right, this is the fair remunerative price. The government, of course, decides this fair remunerative price. And of course, the government wants farmers to do well. So if they increase the fair remunerative price or the FRP, it will obviously impact sugar mills in a negative way. Then, very important, there are several export restrictions on sugar industry in India. When sugar demand is way higher than sugar supply, and they need supply to meet this, then they uh, exert restrictions on export of sugar, right? And which really badly affects the company. Which brings me to a very important point, which I almost forgot to mention, is this. Now, this is from fiscal year 2022, the annual report. And under this, there is one specific thing I wanted to see. It's this. You see exports, like directly under me, there's written exports. These are, I think, LMT. I don't know what LMT is. It's like tons, but LM means something else. But you can see there were exports and a lot of rising exports, like exports of 5 LMT in 2018. Okay, 60 LMT in 2020, and in 2021, 2022, 100 LMT, some tons of sugar was being exported. Now, remember, fiscal year 2018 all the way to 2022. If you remember the operating margins of this company, from that time, we see a massive increase. All right, we see a massive increase. Where is it? I can't find it. From 2018, see 2018, 10% OPM, it rises to 18% in 2021. Because there were no export restrictions during this time, they could easily sell the sugar to like foreign countries. There was a massive increase, a nice increase, pretty stable increase in operating margins. However, around 2022, the government had some or exerted, put on some restrictions, export restrictions. Because of that, they were unable to sell sugar to like overseas. This heavily it seems to have heavily impacted its margins. Where we see nice decline in margins despite revenue increase. And again, of course, then the ethanol blending program came in. Now that's another major source of revenue. Yes, yes, yes. Um, Under this, what did I want to show? Yeah. Under word, this I want to show. This is for again their distillery segment. Here for fiscal year 2025, you can see EBITDA contribution 19%. Fiscal year 2024 was 35%. And they're saying this is the highest margin business across segments for distillery. So that was Dalmia Bharat. Okay, an overview, slight summary. This company has a PE ratio of only 8. Okay, return capital employed, return on equity have fluctuated, operating profit margins have fluctuated. This year's net profits was higher or were higher only due to a seems like a tax refund, 1.5% dividend yield, pretty good sales growth, 10% over the last few years. Um, Again, government restrictions, government policies now will really affect the company again because of those export restrictions. The sugarcane prices, raw material prices, government, FRP, the fair remunerative price that they set, the government sets. Distillery segment is a new revenue source, relatively new, 28% of revenue, and is set to be the highest margin business. Correct? Power generation is one more thing. This year, fiscal year 2026, they will expand the capacities over both sugar and ethanol production. The company, balance sheet wise, does have 500 crores of, I think, short term debt as of fiscal year 2025, not quarter one fiscal 2026. Uh, Current assets are way more than current liabilities, but again, due to majorly contributed by sugar inventory, which is all right. It's kind of all right. The main product is sugar. They need to pile up a lot of sugar after it's produced and then sold because it may go bad. You can't have that. You can't have the sugar go bad. And what else? Debt service coverage ratio was 4 point something, which is really healthy. Current ratio improved to 2.5. Even earlier was 1 point something, more than one. All right. 300 crores of cash for a market cap of 3,000 crores. Pretty good. Really, really big cash flows can be fluctuating, but if you, I think you normalize them. If you take averages of the massive decrease, massive increase, and you average the cash flows, it still comes out to a pretty nice free cash flows and even free cash flows. So that was it. That was Dalmia Bharat Sugar and Industries. Good sales growth. That's all I can say. Pretty good sales growth. Yes. So bye.